Many investors actively search for undervalued areas, believing they offer the best opportunity for future growth. At first glance, it sounds logical. Buy low and wait for prices to rise. However, what if some undervalued zip codes stay undervalued for years or even decline further? This is where many investors make costly mistakes. The common belief is simple. If a zip code is cheaper than surrounding areas, it must have strong upside potential. Many investors assume that price gaps will eventually close, and undervalued areas will catch up. But in reality, price differences often exist for a reason. Some zip codes remain undervalued because of long-term structural issues. These may include weaker demand, lower income levels, limited infrastructure, or lack of economic growth. In these areas, prices do not rise simply because they are cheap. They stay cheap because demand remains weak. Two zip codes can start at similar price levels but move in completely different directions over time. One may experience strong and consistent growth, the other may stagnate or even decline. Without looking at long-term performance data, it is impossible to tell the difference. The key factor is not how cheap a zip code is today. The key factor is how it has performed over time. Strong markets show consistent growth, stability, and resilience. Weak markets often show volatility, stagnation, or long periods of decline. This is why relying on price alone can be misleading. Investors need to analyze long-term performance at the zip code level. By understanding growth trends, rankings, and consistency, it becomes much easier to identify strong markets and avoid risky ones. This is where data-driven analysis becomes essential. Undervalued does not always mean opportunity. In many cases, it can mean hidden risk. At RegionMetrics, we focus on long-term zip code performance to help investors make more informed decisions. Visit RegionMetrics.com to explore real data and better understand market trends. Thank you.